2020. What a year. COVID-19 was more than just a healthcare concern. It caused our global economy to fall apart. According to the World Bank, the COVID-19 recession has seen the fastest, steepest downgrades in consensus growth projections among all global recessions since 1990. The pandemic caused more than sickness and death. It stalled manufacturing and service production and caused substantial labor turnover. The 2020 economic slowdown was expected to carry over to the following years. It truly has. It persists even after 2 years since the pandemic started. To save financial markets from crashing, the government provided trillions of dollars in aid. However, this brought forth inflation and impending recession. Hi, welcome to the Wealth Monopoly. We are in the same storm, but not in the same boats. I'm sure you've heard that line during times of difficulty and disaster. You've heard it even more so during the course of the pandemic. Indeed, a drastic storm washed over our lives in 2020. Some boats ended up wrecked. There were those that barely made it. Lastly, there were boats that rode the storm smoothly. The same is true with inflation. In today's episode, we talk about those that made a luxury cruise out of inflation. They rode the inflation storm on boats, maybe even yachts, and emerged riding a cruise ship. I'm going to tell you about the wealthy's 5 distinct methods to profit out of high inflation. Demand and money supply have a direct relationship. The rise of money supply increases the demand for goods and services. As a result, inflation occurs. An increase in demand leads to the rise of costs. This is a manifestation of inflation. Let's start with the number one way the rich take advantage of this: investing in real estate. Here's a hypothetical scenario to show how real estate may help you with weather inflation. There are only 10 residences in a tiny island which has real estate as a major source of income. As a whole, the island has only 100 people. If equally distributed, each home would be valued at $10. Suppose the government prints $100 to help stimulate the economy. Now, the number of houses remains the same. Therefore, the houses are now valued at $20 each. If you kept cash, the value of your money plummeted by 50%. If you had $10 and could buy one house before, now you can only purchase half of a property. But if you owned a home, the market value of your home quadrupled. Again, that was all just hypothetical. You obviously can't buy a house at only $20, but hopefully you get the analogy. It's important that you do so that you can understand my next point. To avoid a financial market collapse, the Federal Reserve injected $2.3 trillion to the economy as part of a stimulus package. Sounds like a good thing, right? But it actually poses an issue. Housing constructions have been stalled because of labor insufficiency and supply chain bottlenecks. Demand for new homes was increasing, but supply couldn't move at the same rate. This resulted in skyrocketing prices. The only ones who are happy about it are the homeowners whose net worth grows significantly well. An inflationary environment does not only increase property value, but it also raises rental prices. You can borrow money to purchase property. You can totally handle the debt that you have incurred because as a landlord, you have the option to raise your rent rates for tenants, which will help you keep up with inflation. Speaking of debt, it's actually number 2 on this list. Debt usually has a negative ring to it, but high inflation can turn that around. Thanks to inflation, today's dollar is more valuable than that of tomorrow. You can acquire more with borrowed money than you could by saving it. Sadly, the lender gets paid back with money worth less than it was the moment it was lent to the borrower. Let's look at this from the point of view of an average Joe. The only way this could be advantageous for him is if the interest rate is fixed throughout the term of the loan, if the debt existed pre-inflation, and if their salaries increase at the same pace as inflation. To put it simply, if the above criteria is met, then the value of the average Joe's debt decreases. Hooray for him, but the rich still get away with a much bigger smile on their faces. When used wisely, debt can be used to support business growth and to acquire income-generating assets. As mentioned earlier, inflation decreases the value of debt. Between declining debt and increasing assets is even more wealth for those who are already wealthy. Reminding you to take down notes. What you learn today will surely help you move from fearing inflation to taking advantage of it the way the rich do. Before we continue, please give this video a thumbs up. Next on the list is number 3, real assets. Real assets are a subset of wealth. These are tangible assets whose value is tied to their utility, such as commodities. Since commodities are vital for the economy, they are a reliable buffer against inflation. The current price of oil and gas has surely made you scratch your head in frustration, huh? Despite its skyrocketing price, people still spend for it because it is a necessity. Among other things, you need it for cooking and you need it to run your car. Oil and gas are precious resources. Imagine having that in your portfolio and how rich it could make you in an inflationary circumstances. The high supply of money in the economy that causes inflation also triggers a rise in the value of equities. The abundance of money increases the demand for financial assets such as stocks, which is the number 4 on the list. With the increase in demand and the Federal Reserve's attempt to minimize economic money movement, we witness a stock market downturn. This is why you ought to be wise when it comes to stock investment. You need to have a clear understanding of the company's business background before investing in its stock. This will help you identify which will fare best during times of inflation. Investors should focus on companies that can raise their prices to cover the increasing costs of doing business. This is especially important for companies in the consumer staples sector, which includes products and services that people need no matter what state the economy is in. Last but not the least is gold. Until 1971, gold was the economic foundation on which the dollar was based, and each dollar had an identical gold value. This eventually caused prices to climb uncontrollably, aka inflation. Gold is now negatively linked to dollar value. An increase in value of one decreases the value of the other, and vice versa. Gold is a precious metal that has a preserving purchasing power when inflation goes up. Wise and wealthy investors hold gold in their portfolio. These techniques aren't reserved for the rich. You can make use of them too. If you find yourself in a tough situation, don't let it get to you. Fight back. We are in the same storm, but not in the same boats. But nobody ever said you'll have the same boat forever. You can build a better and stronger boat that will weather the strongest storm. Worry not, the wealth monopoly is with you as you strengthen your boat. As always, we are with you as you pursue wealth. Please subscribe to our channel and ring your notification bell so that we could continue to be on this journey with you. See you in the next video.